just take a look at this, and it's on page 123. All right. Now, for task-based simulation number 6. First of all, when you get something like this, you would always look at the requirement first. Before you do anything, look at the requirement. At the bottom of page 123, it says, prepare an adjusted income statement for 2011 and 2010 after the change to the FIFO inventory method. So the new method is going to be the FIFO method. First in, first out means the last one is still there. That describes. Remember, first in, first out describes what's sold and cost of goods sold, but the last one is still there, describes the ending inventory under the FIFO method. So they want us then to prepare the adjusted income statements for 2011 and 2010 after the change to the FIFO inventory method, and then they want us to provide the adjusted balances on the December 31st balance sheet for each year. Now let's take a look at the facts they present us. On January 1st of 2011, Posey changed from the average cost method, which is the old method, to the FIFO method, which is the new method, to account for its inventory. Ending inventory for each method was as follows. And they give you the ending inventory for 2010, that would be December 31st, 2010, and December 31st, 2011, and they give it to you for the old method, which is the average cost method, and then they give it to you for the new method, which is the FIFO method. And notice that for 2010, the new method, the inventory increased from $5,000 to $7,000, so it's a change of an increase of $2,000. All right, and then for 2011, it went from $9,000 to $14,000, so it's an increase there of $5,000. Okay, now Posey's income statement information calculated by the average cost method as follows, and they give you the income statement under the old method, which is the weighted average method, and then assume that Posey has no book or tax differences or deferred taxes. Posey accrues tax expense on December 31st of each year and pays the tax in January of the following year. Oh, by the way, why do they say, why is it important to know the difference between if they say they changed the method for income tax, for book purposes, but not for income tax purposes? Well, the reason is because, let me just go back to that one little example that I had done for the percentage of completion. Let me just digress. Like in multiple choice number 13, in multiple choice question number 13, all right, if you're to do like a journal entry, you would do construction in progress for the 180,000, okay, and then what you would do is you would hit the retained earnings for the 108,000. Now, what are you going to hit then for the balance, which would be the 72,000? Okay. Well, and you just plug that, okay? That's the 40% of this, and this was 1 minus the 40%, which is the 60%, which is net of tax effects, and that would be going to the retained earnings. So what would you do then when you hit that plug? Would you be hitting income taxes payable, or would you be hitting a deferred income tax liability? Well, you would hit a deferred income tax liability if they change the principal for, if they had a change in principal for book purposes, but not for income tax purposes, because then you create a difference between the way you do your accounting for your financial statements versus the way you do your accounting on your income tax return. So that would lead to a deferred income tax item, a deferred income tax liability. Now, if they said they changed it for both book purposes and tax purposes, then what you would have here then is you would just have a tax payable. Can't get away from it, got to pay it, an income tax payable. And that would be the difference just in the type of the liability that you would have. Okay, so I just wanted to point that out to you. Okay, back to number 6, simulation 6. So to prepare the adjusted statement, they said that assume that Posey has no book or tax differences or deferred taxes. They accrue tax expense on December 31st of each year, and they pay the tax in January the following year. The income tax rate is 40%. Prepare an adjusted income tax for 2011 and 2010 after the change to the FIFO inventory method. So they want the revised income statement. And then they want to indicate the adjusted balances on the December 31st balance sheet for each year. Okay, first of all, you can answer this right away for inventory. What is going to be the adjusted balance for inventory under the new method? Wouldn't it just be the FIFO balances that they already gave you? Yes. So you could answer that right away without doing any work. So the inventory balance for December 31st, 2011 and December 31st, 2010 under the FIFO method is already given to you. It's 7,000 for 2010 and 14,000 for 2011. So you just put the 14,000 and 7,000 there. Then they also want to know about the income tax liability, and then they also want to know about the retained earnings. Okay? Now, through the magic of video technology, what I'm going to do is I'm going to put this up on the board. I'm going to solve it for you, and I'm going to show you how I solved it. Isn't video technology great? So what I'm going to do is I've set it up for you, and I'll show you this is how you would solve this problem on your scratch paper. Now, keep in mind, when you go from the old method, which is the average method or weighted average method, to the new method, which is going to be FIFO, not everything is going to change, okay? Certainly sales are going to stay the same. And then operating expenses are going to stay the same. So I marked that sales would be the same. Now the cost of goods sold would change, and because you're subtracting cost of goods sold from sales, the gross profit, which is a calculation, that would change too. Then you subtract the operating expenses, and that would give you earnings before taxes. That would be, and you can't even spell, it's earnings before taxes. It's a calculation. Then you'd subtract the taxes, which are 40%. That would be another calculation. And then you get a net income. So what I did is I went ahead and put in the things that wouldn't change between one method to the other method. And that would be the sales would be exactly the same of 130,000 and 100,000. And then the operating expenses would be exactly the same, which would be 20,000 and 17,000. And then I set up a couple of T accounts. In my T accounts, I have a T account for the old method, and then I have a T account for the new method. So you have the old method and then the new method. And the way the inventory T accounts work is you take the beginning balance, and I'm just going to assume that it's 0. You add the purchases. This gives you a subtotal. You subtract the cost of goods sold. Now I know what the cost of goods sold is because they gave me the cost of goods sold under the old method, and the cost of goods sold under the old method was 90,000 in 2011 and 70,000 in 2010. So I know the cost of goods sold, okay? And that's important because I need to know the cost of goods sold in order to figure out the net purchases. So you take the beginning balances, you add your purchases or the cost of goods purchased. This gives you a subtotal. You subtract the cost of goods sold, and that gives you the ending balance as of 12/31/2010. Then to that you add the 2011 purchases. This gives you a subtotal. You subtract the cost of goods sold, which they gave us as 90,000. Remember, this is under the old method, and that gives you an ending balance, which they told us was $9,000. Okay, that was given information. The 5,000 for 2010 and the 9,000 for 2011 was given information under the old method. So now I can back into things. A subtotal, something minus 90 equals 9,000. So I can tell that this is 99,000. Because 99 minus 9 equals 9. Then the purchases, 5,000 plus something equals 99,000. I could tell you that's 94,000 because 5,000 plus 94,000 equals 99,000. Now that I know the ending balance, it's 5,000. Something minus 70,000 gives me 5,000. That's going to be 75,000 because 75,000 minus 70,000 equals 5,000, and then 0 plus something equals 75,000. Then I know my purchases are going to be 75,000. The reason why it was important to do the T account for inventory under the weighted average method, the average method, is because we had to find the purchases here and the purchases here, and I backed into the purchases by knowing what the ending inventories and the cost of goods sold were under the old method. The thing is this. The purchases are not going to change. Whether it's the old method, which is average, or the new method, which is FIFO, the purchases are going to be exactly the same. So now I know the purchases, and the purchases are going to be exactly the same of 75,000 and 94,000. Okay, so now I have that, okay, and I have some information that I can use, okay, in order to solve this. All right, now let's just take a look at what's going on here. 0 plus 75 is going to give me 75,000. All right. And so that's going to be 75,000. And then I would subtract my cost of goods sold. 75,000 minus something gives me 7,000. Well, 75 minus 7 is going to be 68,000. Okay, so your cost of goods sold now would now be $68,000 for 2010 because 75 minus 68 gives me 7. And then I would take the 7 plus the 94,000, that would be 101,000. And 101,000 minus 14,000. 101,000 minus 14,000 is going to give me 87,000. So my cost of goods sold over here is going to be 84,000. That's, oh, sorry, 87,000. That's because 101,000 minus 87,000 gives me 14,000. So basically what I did is I took the information that was for the purchases and used that same information here because the purchases are not going to change, okay? The purchases are not going to change from the old method to the new method. And then what I did was I backed into the cost of goods sold. I was able to back into the cost of goods sold. Now that I've backed into the cost of goods sold, okay, I can put in my cost of goods sold figures for the new method. The cost of goods sold, which did change, is now going to be 68,000 for 2010 minus 68,000 and 87,000 for 2011. So 87,000 here. Okay, so then 130,000 minus the 87,000 is going to give me 43,000. 43,000 minus the 20,000 is going to give me 23,000. And then 40% of the 23,000 is going to give me 9,200. And 23,000 minus the 9,200 is going to give me 13,800. So now I've calculated my net income as 13,800. Okay, now let's do it over here. 100,000 minus the 68,000 is going to give me 32,000. 32,000 minus 17,000 is going to give me 15,000. 40% of the 15,000 is going to give me 6,000. And 15,000 minus 6,000 is going to give me 9,000. So I've now calculated my net income for 2010 and my net income for 2011, okay? So we could, now that we have our net income, we could also calculate what is going to be our retained earnings, okay? Now, when I come back, I'm going to show you how to fill out the bottom section. Okay, now that we've done the income statement, I showed you how to do the income statement. I showed you what was the same and what would be different and what would change and how to back into the new cost of goods sold under the new method, which is FIFO. When I come back, I'm going to show you the solution and how to figure out the rest of the answers, which are at the bottom of page 123. I already showed you how to figure out the inventory. You just take that information from the facts that are given. The new inventory is going to be 14,000 in 2011 and 7,000 under 2010. When I come back, I'm going to show you the presentation for the income tax liability and for the retained earnings. Okay, well, I had to erase my giant T account for the weighted average method, the old method, because I didn't have any more room on the board. So I already told you what the answers were supposed to be for the inventory, because those are just given. So here's 2011 and here's 2010. And then what's going to happen is that you're going to have to figure out the retained earnings. Now, the retained earnings would be, well, first of all, you had $9,000 from 2010, and we're assuming that they didn't have anything from a prior period, because if they did, they would have had to tell you. So that would be $9,000 there. And then you would take the 9,000 and add it to the 13,800 net income, because remember, net income gets closed into retained earnings. So it'd be 9,000 plus from 2010's net income and the 13,800 from 2011's net income, and that would be a total of 22,800, and that would go into the retained earnings here, okay? Because remember, retained earnings is the balance sheet account and it accumulates. Okay, now as for the tax liability, the $6,000 from 2010 is just at $6,000 in taxes that they owe from 2010, and that would be their liability there. And then it wouldn't just be the $9,200 for 2011, because not only would they have to pay the $9,200, but they would also have to play catch up, okay? And the catch up would be, well, first of all, you'd have the $9,200 from the income tax expense from 2011, and the catch up from 2010 would be, I don't like this here, the catch up from 2010 would be, remember that the inventory increased in 2010 and it increased by $2,000? When you have an increase, you would be debiting the inventory and crediting, all right, your retained earnings, and then all for the net of tax effect, and then also then you would have to plug it to your tax liability. Well, then that would be then the change would be the $2,000, because remember, if you look at the facts for 2010, the average method was $5,000, but the FIFO method was $7,000, so you need an increase in inventory. So you take that $2,000, you multiply that by the 40% tax rate, and you get $800. You add the $800 to the tax liability of $9,200, and $9,200 came from their income tax expense, so that's their liability there. $9,200 and $800 is a total of $10,000, so the tax liability is $10,000. Of course, now let me just tell you, the objective is, you know, you want to pass the exam. So I think if you did the entire income statement, you stuck in the inventory and the retained earnings, you already got enough to pass the exam easily, okay? You know, doing the tax liability, you know, I mean, that's great because it's nice that we solved the entire problem, but if you didn't get to that part of the problem, you'd still be okay because we're looking for the magical number of 75. It does not have to be perfect. You just have to get enough to get the points, okay, to get the points, all right? Okay, so that's how you would solve something like that. Please know how to solve simulation number 6. The reason I want you to know how to solve simulation number 6 is because I think this is a problem, even though it's a little long, it is representative of what they could give you on the exam, okay? And I showed you the little techniques, all right, of how to go from the old statements to the new statements that were given a retrospective treatment, and how to back into all the new figures using purchases, and then you back into cost of goods sold, okay? All right, now let's take a look at some more multiple choice questions, okay? Let's take a look.